Good morning and welcome to this Monday, February 13th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, it is option expiration week. That's point number one. Always got to be aware as we head into options expiration. Monthly February options expire this Friday after the close. And so the thing you always have to be aware of is, where do market makers stand? They are always taking the opposite side of these options. And a lot of times there's an imbalance. A lot of in-the-money calls, not so many in-the-money puts, or vice versa. Historically, it's usually there are a lot of in-the-money calls. And the reason for that is, historically, we tend to do very well middle part of most calendar months. You got a lot of inflows that come in from pension plans, 401ks, and so forth. And as a result, you have a lot of money that has built up prices. This isn't just me talking about this, this February or the last couple of months. I'm talking about since back in 1950. The history of the stock market is that money comes into the market at the beginning of the month. Then we have a profit-taking period that usually runs from about the 7th to the 10th. And then we have another run to the upside. And what that creates a lot of times heading into option expiration week is an imbalance of in-the-money calls versus in-the-money puts. We were pretty heavy in the money calls early last week. And I think maybe market makers may have already gotten off to a little early start for February 2023 as we struggled a little bit into the close last week. Anyhow, we're going to be getting into all that. We'll talk a little bit more about Max Payne and options expiration in just a little bit. First, I do want to have everybody follow me over to earningsbeats.com. If you go over to Earnings Beats, if you are new, first of all, welcome. We love to have new folks. When I look at the market, I just try to give you what I see. I don't have any preconceived biases. I think there are a lot of folks probably think I'm a perma bull, but that's because the market goes up more than it goes down. So yeah, I'm going to be giving the benefit of the doubt to the bulls most of the time. If I see something that looks really bad, like I did at the beginning of 2022, I'll say it. I said in the beginning of the year, I thought we could drop 25% last year. That was from the very beginning of the year when we were sitting at all-time highs. And we did ultimately go down to 34.91, which was about a 28% drop on the S&P 500 before we righted the ship in October and started to move higher. So I have no problems calling tops when I see them, but if I don't see them, then yeah, I'm going to default to being bullish. And I think now that we have had that bear market run, that cyclical bear market in 2022, I think the bottom went in October. I called it back in June, actually, and then we end up going down a little bit lower a few months later. But from there, I think we go higher. Now, there are historical tendencies that we need to be aware of. One of those is that the first half of calendar quarters tend to be much, much, much stronger than the second half. It's a tendency. It's a historical fact. But it doesn't happen every quarter, certainly doesn't happen every year. But we're almost to the middle of the quarter. And the reason that this happens is that January, leading up to, middle part of January, the end of January, it's pre-earnings. The stock market has a tremendous history of doing very well heading into earnings season. And then the earnings come out, usually better than expected for the most part. And I don't think this quarter was really any different. We did have maybe a few more misses than normal, but really, I thought earnings so far, we're pretty much through the earnings season. I think earnings have been pretty good, for the most part, beating estimates. And so that's where you get your run through the middle part of February. After the middle part of February and through March, that can be a little bit more trying. So we're going to find out what the market's got, especially as we come out of the bear market. I'm a little cautious, especially with this being option expiration week. I think it pays to be a little cautious, but we'll see how it goes. Anyhow, if you're over at earningsbeats.com, again, if you're new, welcome. Scroll down. We have a free newsletter, Earnings Beats Digest. Name and email address is all it takes. Hit that subscribe button. We'd love to have you. 3 times a week newsletter, Mondays, Wednesdays, Fridays. Comes out usually about 8:30 in the morning, maybe an hour before the market opens. And we focus on things that are important to us. So clearly earnings, relative strength, gaps. Gaps are big. I'm going to talk about some stocks today that have pulled back because of market weakness and are getting really close or at key gap support. But that's big. Candlesticks, price volume, moving averages, trend lines, maybe the RSI, maybe the PPO, AD lines, different things that we like to look at from a technical perspective will be in here. We could look at major indices. We could review industry groups, or it could just be an individual stock, an ETF, whatever. Point is, it's a very, very short read, couple paragraphs and a chart. And if you haven't signed up, you might want to do so. Also, any of our free events that we do throughout the year, we reach out to our entire EB Digest community. And we have many, many thousands of folks. And we want to thank all of you who have supported us either through that newsletter or through our paid subscriptions. That's how we're here. That's how we, continue to provide the guidance and the research that we do. It's because of our paid subscribers. So certainly a very big thank you to all of you. We do have a member event tonight, and it is Max Pain. This is our webinar. We normally have it on Tuesdays for Friday option expiration. This week, we're doing it on Monday because Tuesday falls on Valentine's Day, and we don't want to get anybody in trouble. No need to get anyone in trouble for Valentine's Day. So we're going to do it one day early. We'll do it today at 4:30. If you're not a member, a paid member, we do have a free 30-day trial. So you have to give your credit card for this one. You don't for the free newsletter. For this one, for our paid service, you do have to give a credit card for the 30-day trial. That's just so we can get you set up in our system. But we will reach out to you before your 30 days are up and make sure that you're comfortable with paying us. We don't want you if you don't feel like we're a fit. I think we're going to be a fit for most of you. The education alone that we provide, the research that we do is top notch. I think it's second to nobody. But again, maybe I'm a little biased, but I know how much time we spend on research. And I think we give our members a lot of great information. Anyhow, if you want to support us with a paid membership, you want to give us a 30-day free trial, we'd love to have you. Today would be great because of the event that we have, the webinar later today at 4:30. All right, moving on. What happened on Friday? How did we close out last week? Well, we did have a little bit of a bifurcated market. In other words, a lot of mixed action. Dow Jones was up 169 points. S&P was up 9, but the NASDAQ lost 71. Mid caps were up 7, small caps were up 3. So on a percentage basis, kind of all over the place. But our best performing index was the Dow, which was up 0.5%. The worst was the NASDAQ, which was down 0.6%. So again, a little bifurcated action. Coming back, though, and basically challenging 20-day moving averages. That's really what we saw at the end of last week. So this week will be very interesting because there's still a little bit more room to the downside to reach max pain levels. But at the same time, we're having a pretty good technical test of 20-day moving averages. I can tell you that max pain is not the same issue right now that it was about 3 or 4 days ago. When we saw the QQQ, which tracks the NASDAQ 100, I think we saw the QQQ get up to about, 315 or something like that. We had max pain back at 290. We were $25 over the max pain level. In other words, $25 in the money on where we need to be from a net call to put balance or ratio. Max pain, that is the point. If you're not unfamiliar with max pain is the point at which market makers pay out the fewest dollars in either in the money, the total of in the money calls, in the money puts. So when there's a huge imbalance, a lot of times what you'll see is on the QQQ, you might have $2 billion of net in the money calls and maybe 100,000 of net in the money puts. And so you have this $1.9 billion worth of net in the money call premium. Now, the action, when you move somewhere in the middle, maybe what you do is you end up paying out like 600,000 calls, 600,000 puts. So it's 1.2 million. So instead of paying out the possibility of 2 million on the call side and 100,000 on the put side. That would be 2.1 billion. Instead of that, you have maybe 600,000 on each side, which you pay out 1.2 billion. Don't you think if you're a market maker and this is your inventory that you might want to start moving prices toward that 290 level on the QQQ? Every dollar that you fall from 315 to 290, every dollar you fall is saving you probably, and this is just a guess, but maybe $50 million. Don't you think that you would maybe begin to use your capital to move prices to the downside as best you can? That's the whole concept of Max Pain. And the beauty of it is it's a very short-term inefficiency in the market. So when you're sitting there and you're wondering why the stock market, after having a big run, all of a sudden is falling apart upon some hard times, a lot of times look no further than the market maker and look no further than Max Pain. From a sector perspective on Friday, you can see energy performing really well, up 4% to close out the week. We're back up above $90. I'm seeing, and what I told members, and I may have shown it on the show as well, but I'm seeing an ascending triangle here. I see a move up on energy. I see equal prices. I see a low here and continuing low. So I see the move up. That's point A. Point B is your first low. Point C is the equal high. And point D is the final low. A, B, C, D in an ascending triangle, equal high, rising low. If that breaks out above 93 or 94, that measures from the top of this triangle, 93, down to the low, which looks like maybe around 82. That would put us up at about 104 measurement. So watch for that breakout on the XLE around 93, 93 and a half. If we do see it, technical analysis, this pattern measurement takes us to 104 on the XLE. Utilities also had a pretty good day on Friday, but they've been in a downtrend. I'm not sure they get back through the 20-day. This is a group that tends to underperform when the market is strong. And so as we have been rallying, you can see January and into February, what utilities been doing has been going down. Again, the tendency there is to underperform. Last week, though, it was all about defensive, more value-oriented stocks and not so much about discretionary and more aggressive stocks. So this is what we saw last week, some selling in discretionary, communication services, technology. Think about it. These are the three areas where you have the most money in terms of options. So all of these moves in these various areas that were going higher, keep in mind, there was a lot of in-the-money call premium building, not just on the XLY, XLC, and XLK, but on many of the stocks that comprise those ETFs. That tells you you've got to be careful. Sometimes you get market makers take the carpet right out from under you, just over a very brief period of time. But this is the time when it can happen. Communication services flying high into the beginning part of the month have been pulling back. There's a reason for it. Part of it's profit taking, part of it's market makers jumping on board. Throw in a little media action. Got to throw my little media rant in there. But I'm sure, there's going to be more media to come. That's never going away. Get ready for that. Anyhow, this week's going to be interesting because I do think we're getting closer to key technical support levels where the market could certainly just turn right back up to the upside. But have the market makers inflicted enough damage at this point? I don't know that they have. I'm still a little careful. And by the way, one key economic report out this week you need to be aware of tomorrow morning. The January CPI report will be out. Now, I think even the Fed now has acknowledged that we've moved into a period of disinflation. Disinflation and deflation are two different things. Disinflation is the reduction of the inflation. So instead of being 6%, it goes down to 5% and then 4%. That's disinflation. That's the lowering of the inflation rate. Deflation means prices turn negative. The inflation rate goes negative. And that is what happened to Japan back in the 1990s. It happened to us back in the 1920s, late 1920s, early 1930s, when all prices of everything collapsed That's what deflation looks like. That's what Japan saw for 20 years, starting in 1990. We don't want any part of deflation. If you think inflation is bad, multiply it times about 10, maybe 100. So the Fed's kind of, got to be very delicate in walking the tightrope, because you want to raise rates enough to slow the impact of inflation, but you don't want to go so overboard that you kill the economy and kill demand. Now, we just had the jobs report out recently, 10 days ago. Didn't show any slowing. Still, looking for workers, hiring, lowest unemployment rate in history. So I think we're okay there. But the Fed, starting to tap on the brakes a little bit as far as rate hikes go. I think they need to continue doing that. Obviously, they're going to be data dependent. But anyway, getting back to my point, tomorrow morning, CPI comes out, and that is the one report that can drive the market crazy in the short term because of all the worries and all the fears that are out there. So if tomorrow morning's report is just a little hotter than expected, that could be all the market makers need to take this back to max pain. Especially, rates, 10-year treasury yield's been going up. In fact, let's take a look at that real quick. Here's the 10-year treasury yield. Currently, I didn't even give you futures and all. The heck's wrong with me? So right now, futures I'm showing are mixed. Actually, the best way to look at the futures, let's go back over here, because the futures I'm showing are on delay. So let's just look at the diamonds. So right now, diamonds are flat. So nothing on the Dow. Spider's going to be up a little bit here, up a little more than 1/10%. And the QQQ, which tracks the NASDAQ 100, up about 0.4%. So it looks like we're going to get off to at least maybe a little bit of, have a little strength here on Monday morning. Mondays, if I'm going to give you another piece of historical evidence or tendencies, Monday historically is the worst day of the week. And on the S&P 500, I believe the annualized return on Mondays since 1950, the annualized return was minus 14%, has been minus 14%. Whereas all the other days of the week are positive. And when you get Wednesday to Friday, that's when the strength comes. So it's almost like it's a Monday blues. Market gets off to a slow start. Who wants to work on Mondays? Who's in a good mood on Mondays? I think a lot of it's psychological. But anyway, Monday's week, and then the rest of the week tends to be much stronger as you go throughout the week. Usually you finish the week on a high note. That's not me saying, again, last couple of weeks or last 6 months, that's been the tendency. I have the numbers to back up since 1950, 73 years of data. And you might say, well, Monday is just one day of the week. Well, yeah, it's one day of the week times 4 or 5 weeks a month times 12 months a year times 73 years. Mondays is one day out of the week. So it's roughly 1/5 of all trading days since 1950. It's a lot. It's a big sample size. You got to be aware, because Mondays do tend to be bad. And the worst Monday is usually the Monday after options expire. Options expire this Friday, so it would be next Monday. The odds of going higher on a Monday following Friday options expiration is 37%. 63% of the time you go down. Just want to give you some odds. So it's not a guarantee. 37% of all Mondays that follow options expiration go higher. 47% of all Mondays go higher. So it's not like it's 90% versus 10%, but there's a tendency. When you get into Thursdays and Fridays and Wednesdays, actually, I think Wednesdays is the best day. Wednesday, Thursday, Friday, you tend to see about 55% of the time the S&P 500 goes higher. So there's meaningful data, and it's certainly a meaningful sample size to indicate that we do tend to be a little bit weaker on Mondays. Anyway, just food for thought. So the 10-year treasury yield right now, it is down a little more than 1 basis point this morning, 3.73%. Crude oil down about 50 cents. So we are below $80 a barrel at about $79.20 right now. But that's a little higher than where we were. And again, 10-year treasury yield, 3.73%. And as we broke back out above the moving averages, what I said is let's watch 390 to the upside. I think that's the key resistance level. And to the downside, 340, 337, 337. So I think we've got our range established here. This is going to be important because if the inflation comes in a little hot tomorrow, what happens to the 10-year Treasury yield? Usually you sell bonds when inflation is hot, which sends the yield higher. Do we go back through 390 if inflation's a little hotter than expected? That will be something to watch. If we do, then I think we got more downside in the stock market. If the inflation's hot, we gap down in the market, but we don't go through 390 and we start to see that 10-year Treasury yield roll over, I think that would be a much better sign for stocks. The stock market's probably going to take somewhat of a cue, usually does, from the bond market. That's why I always keep an eye on the bond market. Moving on, S&P 500. So we finished at 4,090. I mean, honestly, all we did so far is go back and test the 20-day moving average. So it looks like nothing more than a little selling technical test. But again, following options expiration and max pain the way I do, I know it's probably a little bit more than just a test. Probably have some real issues that we have to deal with here. And probably for the next few days, we'll see what happens. If we do get down another 1 or 2% lower, I think max pain is in the rearview mirror. And so that's what I've told members that, hey, if you like to leverage a little bit with your ETFs, like if you're in the QQQ and you like to play, say, the QLD, which is 2 times the QQQ on the long side, that's the 2 times bull ETF, or the 3 times bull ETF, which is the TQQQ. If you want to get into something like that instead of the QQQ, to me, it makes sense. Number one, on a 20-day test. If I pull up the NASDAQ, we're not quite down to the 20-day, but the 20-day would be one area. And then, of course, max pain on the QQQ. We'll talk about this a little bit later, but I believe it was 291, right around 291, maybe 291 and change, which would be down here a little bit below the 20-day. But my point is, while we were flying, you don't necessarily want to be establishing a new leveraged ETF position because, number one, you've got options expiration coming up. Number two, you're way overbought already. If you want to initiate a leveraged position, do it when you're at support. So if you're wrong, you can get out quickly. You don't want to be riding leveraged ETFs for the long term, in my opinion. Now, if I knew for absolute fact that we're going back to all-time highs, and I think we are, leveraged ETFs will certainly do better. But if we go through periods of consolidation, look at the QQQ here. You see how the QQQ here on the low is above this low? Look at the TQQQ. The TQQ, the low goes below that low. You're like, wait a minute, it tracks the NASDAQ. How can that be? How can it, if it tracks the QQQ and the QQQ holds the support, how does the TQQ not hold support? Well, it's all in the leverage, the options, and everything else that's used for the TQQQ to track the QQQ. That's, I mean, when you look at these leveraged ETFs, they are designed to track their underlying security or ETF, whatever, for that day. They're not designed to track exactly 3 times for a month or 3 months or for a year. They're designed for a day, which is why when you find a bottom and you think you're going to trend higher, that's the time you want to get into these. What happens is over a period of time, these leveraged ETFs erode. They lose a little bit of value. Every time you go up and back down to the same level on the QQQ, you're going to find that the TQQQ loses ground. Now, because of the compounding, when you find an uptrend like this, many times the TQQQ will more than triple the QQQ. In other words, you actually do better than 3 times when you catch an uptrend because of the compounding effect. If you take, if you're at $100, you have $100 invested in the QQQ and it goes up 3% today, and then another 3% the next day, you're up 6%, from that 100. So you're at 106. Well, the TQQ basically resets itself every day. So yeah, it goes up 103, or it goes up to 109 the first day. If the QQQ is 103, that would be 109. It's going to triple the return. And then the next day, because of the compounding nature of it, you're actually going to see a little bit more. You'll get 3% on 109, but it'll be more than, anyway, you got to do the math. I don't want to try to, anybody who doesn't do math well in their head probably is reaching for the X on the screen right now. But just trust me, when you go up and down, that's why you lose a little bit of value. So you don't want to just hold these in a period of consolidation. You want to be in these when they're trending. That's my point. We'll leave it at that. All right. So let's talk a little bit. What did I want to talk about here first? Let's go into, I want to show you a couple tricks here at stock charts. So let's just say we're on the QQQ. And I have all these style buttons over here, and I get questions all the time. How do you set up these style buttons? So for instance, when I have the QQQ, if I wanted to go to a 5-day, 10-minute chart, I would have to go down here and I'd have to change the period to 10 minutes. I'd have to go over here and get, okay, I want 5 days. How do I want to set this up? I'd have to do all of that. Well, I'm sitting here on the daily chart. I set up a chart style button. I click on it, and there's my 5-day, 10-minute chart. Oh, I have a style button set for an hour. I want to see an hourly chart. There it is. How about the daily chart? There's the daily chart. Then I've got a weekly chart. Then I've got a monthly chart. Then I've got, this is some kind of a percentage. I think I do this for the equity only put call ratio because it's a line chart instead of a candle. Then what about if there's dividends involved in a stock? You got a stock and you want to see their history of dividends. I've got a dividend style. I've got what I use for my ETFs, for our strong ETF chart list. I like to use, because I like to have scooters on here for the ETFs. That's one of the reasons, or that's how we pick a lot of our ETFs, is going through and looking at the scooters. There's for relative strength on earnings. So let's say we'll pull up, Caterpillar. So if I want to look at Caterpillar on a relative strength basis, here's Caterpillar going up, and here it is relative to its peer group. So I've got that preset. I've got relative strength set up here. So there's the AD line on Caterpillar. Here's the stock, and this is how the stock is doing relative to its peers and how its peers are doing relative to the S&P. So a slight difference there. Then I've got another relative chart that I've got up here, and I've got more relative action down here. And then I've got, this is what I use for the 10-year Treasury yield whenever we're talking about it on the show. This is my 10-year Treasury yield chart that I always show. So those are all of the preset style buttons. You can have a bunch more if you want. So the question is, how do I do this? Okay, so let's set up first what you want to look, how you want your chart to look. So let's say you're going with a daily chart, but you only want 6 months. So you're going to say 6 months, and maybe you don't like candlesticks. Maybe you like bar charts. So we'll go with thick bar charts. And the color scheme, you want graphite. And, wow, okay, you already changed it for me, but it didn't set up the style button. But here you want the MACD, and here you want full stochastics. And so this is your new style that you want. And you want to save this. You won't have to go through this every time you want to look at this chart style. What you do, you see this little plus button right here? Hit the plus button. What do you want to call it? My new chart style, whatever you want to call it. And you add new. And now you've got a button over here. Now it reorganizes. So then I'd have to go back in here and move everything back around again, because I don't know why, but it automatically changes these. So I got to get my hourly, daily, weekly. I like to put them all in certain order so I know where they are. Those are the big ones. Okay. But there's my new chart style down here. So if I want to bring it up and make it a button, what I have to do is grab it and drag it up. And so there's, whoops. There. So there is my new chart style. I'm going to go down one more. There we go. All right. And so now I'm done. And so there's my 10-minute 5-day. But if I'm looking for that new chart style I just created, there it is. There's that button. So every time I want to use that now, I can just click on that button instead of having to go down and reset all of these. I mean, it's massive time saver, especially if you like to flip back and forth. All right, market just opened, so we're going to wrap this up here in about 2 seconds. I did want to talk a little bit. One of the charts that or the chart that I showed in the EB Digest this morning is Meta, and Meta gapping up a little bit today. Got to be a little leery of Meta. First of all, I love Meta. After that earnings report and that big gap up, I love it, but I wouldn't be surprised if we're going to see a 20-day test here, maybe even a little bit more. Max pain on this, $131. That right there is the point at which market makers would save the most amount of money on options come this Friday. Now, is Tom saying that we're going to fall from 177 to 131 in 4 more days? No, please do not misunderstand. I use these max pain signals as directional clues. Much like many of you might use the PPO or the AD line or whatever technical tools you like to use, maybe the RSI. I look at max pain that says 131 and I think in my head, okay, market makers have incentive to drive prices toward 131. One thing you have to understand is, and this is really important with max pain, if we don't go to 131, even if we go back up to 190, chances are market makers are not losing money. Don't feel sorry for them. Because on the way up, when everybody was buying calls, market makers are not just selling the calls naked. If they are, then they deserve their losses. I'm not a market maker, never have been a market maker, but I can almost assure you that if you're putting these options contracts on your books in your inventory, you're selling call contracts. If I was selling 10 call contracts, I'm going to buy 1,000 shares of the stock. It's called a covered call. That's an option strategy. You can't lose money to the downside like that with the covered call. As a market maker, if you sell the call and you buy the stock and the price keeps going higher, you're protected because you own the stock. You're actually going to pocket the value, that premium that was on the option. So don't worry about them if prices keep going up. They should be protected. And if they're not, that's their problem. But if I was a market maker and I was selling options, I would absolutely buy the stock when I sold the option. Because market makers are just trying to make money on as many transactions as they can. They're not trying to make a killing. But the thing is, when you get a stock like this, and market makers had to go long because everybody's buying calls, so market makers are long, you get this big gap up, then you've got a situation where everybody is buying on this move to the upside. And who provides liquidity on that? Market makers selling. So now it's an easy move to go from being long to being short and to start driving the price down. And listen, believe me if you want, don't believe me, it's completely up to you. But I've been following the market for a long time. I've been studying it for years before I was ever born. This has been going on ever since I've followed the market. Options expire and prices will gravitate. So just keep that in mind. I would not be surprised if we keep moving lower. It doesn't guarantee us that we're going to move lower. It may go higher. But the question is, if you were looking to buy Meta or Facebook after earnings, and you knew max pain was at 131, are you going to be excited about buying at 183, 190, 195? I would not do it. I think the risks are too great. Not that the stock couldn't go to 200, 210, 220, keep going higher, but I manage risk. I'm trying to evaluate my risk. And that tells me there's way too much risk in this stock right now. So I got to get through the end of the week. Let's see where we are. But I do like Meta, and I'll like it a lot more if market makers create a selling atmosphere this stock or this week for the stock. All right. Wanted to just go over just a couple quick stocks that I had given out just to show you a little bit about what we do at Earnings Beats. So I'm going to start with ITW. This is Illinois Tool Works. I love these stocks that make the breakout, big volume, and come back and test the 20-day. This one actually is testing price support at the same time. So this is a really nice area to potentially see a reversal. Not a lot of option activity on Illinois Toolworks. I always like to check that out. If I'm going to buy a stock before, week of options expiration, I want to know where Max Pain is. I want to know how heavily the stock is traded in the options world. It's not very heavily traded. And I think the options that are out there are probably right around this price. There's really no outside option influence during the week of Max Pain. So ITW is one. Let me give you one other one. Trying to think what else I had that I talked about. No, I can look down here under the raised guidance. That's where they all came from, our raised guidance chart list. I'll just give you one more, and then we'll look at the market. We'll wrap up here. Just trying to see if these ring a bell. TWOU is one. This one, look at the gap support right here. So I'm going to inspect. When you get a big candle like this, you gap up. We opened at 983, and the stock was traded 6.6 million shares that day, one of the heaviest volume days of the year. And once it gapped up, remember, market makers are shorting at the open. Stock kept going up the rest of the day. That's a good sign of a lot of demand. And when you come back and you test this gap support area, a lot of times that's when you want to get in. I sent this out to members. I believe the stock was trading around 980 or something on Friday when I sent it out to members in our daily market report. I mean, it's already back up over 1007. You could take some small profits, but I think the stock has a legitimate chance to make a run back up toward 13. So now it's about managing risk to the upside. Keep your stop fairly tight. And if it gets up to 11, let's say it makes a big move today and it's up 10%. I probably would take that. Even though potentially it could go to 13, 10% or 12% in one day. Do you want to risk that to see if you get back up to the top? What if we just come right back down to the gap support? That's a possibility. So if you make a quick move to the upside, I tend to take my money. If it goes to 13, congratulations, whoever held, made more money. That's wonderful. But I'm only concerned about my account. I want to see my account go up. So anyway, this is another one. I ended up putting maybe 7, 8, 9 of these types of trades out to our members on Friday in our daily market report. And then went over many of these same stocks in our weekly portfolio report that I wrote yesterday for members. Anyway, that's the kind of stuff that we do at Earnings Beats. So if you do want to try us, again, go over to Earnings Beats. You got a no-cost trial for 30 days. Come join us tonight for our Max Pain webinar. I promise you, if you don't know anything about Max Pain and monthly options expiration, this will be an eye-opener for you. It will immediately take your trading to another level. Anyhow, let's see what's going on in the market. Get a final look, see if we're holding on to gains or what we're doing. We flipped, though, in terms of strength. We saw a lot of leadership in NASDAQ in pre-market. Now it's kind of flipped. And that makes sense to me because it's option expiration week. And these NASDAQ stocks are much more heavily traded in the options world than the Dow stocks. So this is the group that you've got to be careful at when you have a big run up heading into Max Pain week, option expiration week. So don't be surprised if the NASDAQ struggles more. Not a guarantee, but I would say that there could be the next few days a tendency here for the NASDAQ to underperform. I talked about this with members probably a week or two ago, saying that we'd had such a big run up that it wouldn't surprise me if we saw money rotate back towards the Dow and the S&P for a little bit while the NASDAQ cooled off. And I think we saw at the end of last week, and I wouldn't be surprised if we see a little bit more of that this week. Anyhow, that's where we are. That's how we're starting the week. Appreciate everybody tuning in. Be sure to check us out over at Earnings Beats. We'd love to have your support. If we don't fit, hey, we don't fit. That's fine. Completely understand. But I think you may love what we do for our members. Anyhow, have a great day. Enjoy the rest of the day and join us at 4:30 this afternoon. Happy trading, everybody.